Welcome to episode 4 of the Retirement Roadmap series here on the Canadian Money Roadmap podcast. In our first 3 episodes, we meticulously organized your finances, built a sturdy foundation, and set precise targets for your retirement dream. Now it's time to tackle the most crucial question of how are you actually going to get there. Join me as we deep dive into the strategies and income sources that'll actually pave the way to your retirement. And stick around because I'll actually show you how to find your CPP and OAS estimates for you and your situation so that you know how much you should anticipate from those programs in addition to your other income sources, so you know how much you have to come up with on your own through savings, through RSPs and TFSAs and things like that. So if that sounds good to you, we'll get going today on the Canadian Money Roadmap podcast. All right, and welcome back to episode 4 in my Retirement Roadmap series. And so if you haven't listened to the episodes previous to this, so far we've covered getting organized. So that's getting all your financial stuff in one place and having an idea of what you have and what you don't have. Then the next one is building your foundation. So those are the critical things that you need to have in place before you even worry about growing your wealth for retirement. The next one we talked about last week was picking some targets for where you want to go. So specifically, that was your anticipated retirement date and how much you anticipate needing to spend. And so today we're going to talk about how you're actually going to get there. So back in 2010, that doesn't sound like that long ago, but it's that was 14 years ago already. But back in 2010, I went on a little bit of an adventure and I was in Greece. And I spent about 6 weeks living on a sailboat and learning how to sail and all that kind of stuff. And if you're not familiar with me, I'm from Saskatoon, so I'm right in the middle of the prairies. And so living on a sailboat was pretty far out of my comfort zone. So that was a fun thing to do. But anyways, part of getting there was a bit of a crazy experience. So this was not cruise ship Greece, where you're going to the like Mykonos and the fancy islands and things like that. No, this is like real Greece. I kind of always related it to people who go to Mexico and they go to Cancun and Puerto Vallarta. It's like, no, there's a lot of Mexico that does not look like those places. And so this was partially my experience there. So getting to where I needed to go, which was a city called Volos, and Volos is not somewhere that the average tourist is going to end up. And so it was a little bit tricky to get there. So when we landed in Athens, I didn't have a cell phone. So I had a cell phone, but I left it back in Canada. So to put this in perspective, in 2010, just that month, so this was in September, that month was when the iPhone 4 was released, and that was the first one that was really available on most networks outside of Rogers here in Canada. So the first few are only available with Rogers. And here in Saskatchewan, Rogers doesn't really have much of a presence at all. And so that just wasn't a thing. So iPhones and smartphones weren't really commonplace. And so I didn't have a cell phone, but I did have an iPod Touch that I could kind of get some internet services on, but finding Wi-Fi everywhere was pretty challenging too. But when we landed in Athens, I had on paper the list of all the different types of transportation we needed to take on all the different days leading up to getting to Volos to get on the sailboat and take off on our trip. I'm saying because there just happened to be a couple other people from Saskatchewan that were doing the same trip, and we connected in advance. I didn't know Aaron and Stephanie beforehand, but we connected in Saskatoon, and we ended up flying out together. And so we were kind of on this pre-adventure together. So anyways, I had discussed with them, and we had figured everything out, but we had everything planned out on paper. So we had maps, we had instructions, we had directions, where to find the train stations, all these kind of things. We had it planned out. Now, when we landed, we get on a bus because that was part of the plan. We knew exactly that there was going to be a bus that goes in this direction at this time, and sure enough, there it was. But then as we were going, we were supposed to get off at our hotel, and it was not obvious that there was a stop or that this bus was going to make any frequent stops. It just kind of kept going. So anyways, long story short, we ended up missing the bus. We ended up missing the stop. And so we had to get off in the middle of nowhere after flying from Toronto to Athens. It was a long day. And we ended up walking backwards because we realized, oh my goodness, we passed this place. So we ended up walking on the meridian of a highway wearing clothes that were not good for the Greek heat, hauling our bags because we were going to be living on this sailboat for 6 weeks. And so we had tons of stuff. And yeah, anyways, this was quite the sight. So we had a plane, we had a bus, we'd done some walking. Then we eventually got back to our place, and that was fine because we kind of took our map out and we figured out, okay, this is where we're going, and we were able to get some help along the way. Then a couple days later, we were supposed to make our way from Athens up to Volos, but that took some effort as well because you had to take a train, and there was an issue with some striking that was happening. And so we had to get a little bit creative with timing and what trains were available and all this kind of stuff, but we had a plan. So we went from our hotel, we got on a bus, we got to a train, we made it up to Volos, and I think we had to take a cab from there, and then we got onto a sailboat, and then anyways, that was kind of how it went. So the reason I'm telling this story is that we had a destination in mind. We had a date that we had to get there, but we're going to take a variety of different types of transportation to get there. But without a plan, this would have got really off the rails really quick, and we probably wouldn't have gotten there. Or when we inevitably miss a bus stop or whatever, it would be much, much harder to get back on track if we didn't have an idea of where we needed to go or who we could ask for help or anything like that. And so this is much the same like your retirement income. So when you're working, you have income that comes from your employment. So you show up at work, you get a paycheck. When you're retired, it's not that simple. So you have things like CPP, old age security. You might have pensions. You might have multiple pensions because you might have a spouse and they might have CPP. They probably have OAS as well. And so now your household income, maybe it was one income before. Now you might have 4 or 5 because you might even have an old pension from before that you've converted into a LIRA. You might have an RSP. You might have non-registered investments that have dividends. You could have rental properties. You could have all these different things. It gets complicated. And so without a plan in advance, you might not know if you're going to be falling short or where you're going to end up. So in today's episode, we are going to come up with a plan to figure out what sources of income you're going to have and approximately how much they're going to be. Think of this like your planes, trains, and automobiles of getting to your retirement end goal. So let's start with the big one that most of you are going to have. If you have employment income in Canada, that means you've contributed to the Canada Pension Plan. And so I don't know how much you're going to expect, but this is how you can figure that out for yourself. If you log on to My Service Canada, just type that into Google, My Service Canada. You've probably never logged in there before, but there is a lot of information that you can find here, and it's really great. On the YouTube channel, I'll show some screenshots of what this looks like, just so you have an idea. But essentially, once you log in, you can use the same login process that you would for MyCRA. So that's your Canada Revenue Agency, like where you could see things about your taxes. My Service Canada has a lot more to do with your benefits. So this goes through the Department of Employment and Social Development. And so there's lots of things that are available there that you wouldn't find on your MyCRA account. So on My Service Canada, there's going to be a menu. Once you log in there, there is a section for CPP. So there's a variety of different sections. So you click on the Canada Pension Plan. I think it's most of the way down the list. And then once you get in there, you'll see a screen that looks like this that has something that says payments. And then there is something below that, like another submenu that says View My Benefit Estimate. Click on that, and that will bring you to another page that will give you a ballpark estimate of your CPP retirement pension. It'll give you a couple of different numbers. Again, if you're just listening to the audio version of this, you can hop over to YouTube and you can see what I'm talking about. But it gives you 3 options. And I've got an example here showing that at 60, you could receive, in this case, the example is $577 per month. At 65, you could receive $901. And at 70, you could receive $1280. And those are just the differences between your start date and the reduction or increase that you get based on the start date that you choose. These estimates are not set in stone. These are not your guarantee amounts. These are simply estimates based on the contributions that you've made in the past in your employment history, and they just use a factor of those things to project out into the future of what they think your anticipated income might be. So if you're in a job that you feel is pretty consistent to what you're going to do for the rest of your working life, this estimate might be pretty close. It'll never be exact, and it'll never be exact until they actually start writing you checks or like depositing money into your account, because at that point, that's when they do the formal calculation. But for this stage, if we're just kind of just getting a high level view, this is what I'm going to call good enough for now. So if this person is wanting to retire at 65, let's just use that figure that they give here, $900 a month. I'm just going to round it up, 900 in this case. Cool. So that's for yourself. Now, I assume if you're listening to this, you're probably not listening to this with your spouse. Maybe you are, and that's pretty cool, but that would not be the typical experience for my listeners. For most people, there is a money person in the household. That's just natural. That's very, very common for one person to take the lead on money things. But if you are that money person, let's loop your spouse in there, and hopefully you can log in with them to your My Service Canada account and see what their estimate is. Okay? Because assuming you do your household spending together, most people do that. Some people split it, and that just, my opinion here, makes your life way more difficult than it has to be. But if you do everything together, this is a great way to do it. If you split it, you're treating yourself like a single person, but your taxes are going to be together. So anyways, you're just going to make your life more difficult. But if you're doing everything together, make sure that you know your CPP amount and your spouse's CPP amount and get on the same page with them about that. Okay, so that's CPP and how you can find that information. Again, that's through My Service Canada. You can log in and you can get your CPP estimate whenever you want. You don't have to be near retirement to get that estimate. Okay, old age security is a similar but different process for figuring out how much money that you can anticipate for old age security. OAS is something that shows up at 65 or later if you choose to defer. I have some videos on the YouTube channel about old age security, including a 3-minute review of how the program works and what you could expect there. And you can check that out just for a quick, literal 3-minute overview of the program. But if you're still on your My Service Canada page, you can find the old age security section, and then you can go to the payments section again and then estimate my benefits. When you click on there, it's going to be a little bit different because you don't contribute to OAS. You receive it based on your financial circumstance and your residency circumstance, like how long have you actually lived in Canada. And so instead of just spitting out a number at you of what you can expect, they will put you through a little bit of a questionnaire, and they'll ask you things like, how long have you lived in Canada? Do you have a spouse? Do they live in Canada? What sources of income do you have? This is what we're trying to figure out. But that's the kind of stuff that they're going to figure out, because old age security gets reduced if you have too much income. So if you say, okay, well, I'm going to have $120,000 of income, my spouse is going to have $250,000 of income, you're not going to get any OAS. But if you have more typical range between $50,000 and $90,000 a year, you should still qualify for the full amount of OAS, because that amount increases with inflation as well for the reductions. Sometimes we call it clawback. The technical term for it is the recovery tax. And so anyways, that's OAS and how that works. So go through that calculator and you'll be able to estimate your benefits. If you have really low income, they'll give you an estimate for something called the GIS, or the Guaranteed Income Supplement. I haven't talked about that one a lot because I don't have too many clients that ever qualify for that. It gets a little bit complicated for qualifying for GIS, so I'm not going to go into that today. But if you answer the questions to the best of your ability, they'll let you know if you qualify for the Guaranteed Income Supplement. Your income has to be pretty low for you to qualify for that. So the bulk of my listeners here to the podcast are not going to be qualifying for that. But if you have lived in Canada for your whole life, then you would typically qualify for the full amount of OAS once you get to 65. In this case, as we're recording this today, again, this goes up every quarter, actually. So CPP increases with inflation every year, and OAS increases with inflation every quarter. So it gets a little bit complicated for when those adjustments get made. But as we're recording this today, the monthly maximum for old age security for someone that's lived in Canada their whole life is $718 per month. Let's say 700 just for the easy math. So in this hypothetical case that we're going through here, a person has $900 from CPP and $700 from OAS. Let's say they have a spouse, and let's say they get the exact same thing from them. So you can go through your spouse's situation. Maybe they're new to Canada and you're not. You can figure out exactly what you can anticipate for old age security just by going through that calculator. Now, before we go too much further, these numbers that we're talking about from these programs, so CPP and old age security, and the amounts that they list as far as your estimate goes for how much you can anticipate at different ages. Those amounts are gross. Gross means there's no deductions taken off of them, and those amounts are taxable to you. They're treated just like employment income would be. And so you add that to whatever other sources of income you have to determine how much tax you have to pay. If you don't have any other sources of income, you might not actually have to pay any taxes because you might be under the personal exemption. Who knows? So I can't tell you how much tax you will have to pay, but it is treated as taxable income. Okay, so that is going to be a factor here to consider as well. So the next really common source of income that you'll probably have to account for is something called a pension. And you might have a pension or you might not have a pension. There are two main types. One is called a defined benefit pension, and that's exactly what everybody thinks of when they hear the word pension. That means like guaranteed income for life. You retire and you get on your statement, whatever it says, you get that amount for the rest of your life. And it might increase with inflation, it might not, all depends on your pension. The other type of a pension is called a defined contribution pension. Sometimes you hear the language of money purchase plan or something like that. That's kind of language that we don't see as often, but defined contribution pension is another type of pension that is much, much, much more common than a defined benefit pension. A defined contribution pension is kind of like RSP matching in a way. So money goes in from your paycheck, essentially, and then your employer typically matches some money that goes in there. Then you take on the responsibility of actually investing that money. It's usually through an insurance company, so like Sun Life, RBC, Manulife. These are really common. Canada Life is another really common defined contribution pension provider. And so money goes in there, and then you'll have a variety of investment options. Again, all depends on your program. And then you select the investment option that is most appropriate for you. And then when you retire, now you have options, and you got to turn that pool of money into income. I'm not going to get into the mechanisms of how you would do that, but it's all on you, and you carry the risk of making that pool last as long as you need it to. For most people, the plan is to spend all of that money first because it's a little bit more restrictive in terms of how you can access it, but that's up to you and your plan. But pensions are really critical to factor into your retirement income strategy because a defined benefit pension, that is just another guaranteed source of income that makes the calculations really easy. But a defined contribution pension, you can kind of treat it like an RSP in terms of the savings that you have to come up with on your own, because you carry the risk and you carry the responsibility of setting your payments to whatever you need or want it to be. In some cases, once you get to retirement, a defined contribution pension would have a maximum withdrawal amount per year. And so that can make things a little bit complicated too. If you live in a province like Saskatchewan, we don't have maximums on those, but again, all depends on the province that you live in. The main thing that I want to get across today is understanding what type of pension you have and whether that is a guaranteed source of income or a non-guaranteed source of income. You just need to know so that you can plan accordingly. Again, the defined benefit pension is a guaranteed source of income, and a defined contribution is not guaranteed. You could buy an annuity with it or something like that to turn it into guaranteed, but as it stands in concept, it is not a guaranteed source of income. Okay, so now you figured out your OAS, your CPP, and taking a look at whether you have a pension or not. That's going to be pretty easy if you know you don't have any pensions. But then from there, you might have some unusual sources of income. Let's say like rental income. I've seen royalties before. Employment income if you plan on maintaining some sort of business or you have a hobby business or something like that. This is where you need to look into your own situation and see if there's any unique situations that would provide you some income in the future. Then you have to be honest with yourself and determine whether those are actually realistic to continue throughout your life, or if there's a defined end date in mind for those things. So for example, if you currently have some rental income from a rental property, but you hate being a landlord and you plan on selling it, I would not factor in the rental income into your equation here. Same thing with employment income. Be realistic with yourself. Are you going to work until you die? You might think that, and you might say you're going to do that. How many 90-year-olds functionally on their deathbed do you see out and about in the workplace? That's not how it works. So eventually you're going to be leaving the workplace one way or another, whether it's on your own or because of your health or something like that. So you just need to take a look at your unique situation to see what sources of income you have above and beyond your pensions and government benefits to see if those are actually realistic to factor into your plan, or if those are just kind of nice to have, like gravy type of income sources that may or may not be there for the long term. All right, and now your final source of income. This is kind of where the rubber meets the road, and this is where I'm going to wrap up for this week, and we're going to talk about this more next week in terms of some of the specifics. And this is where you're going to want to be subscribed to the YouTube channel, because it's going to be a little bit more visual, and I can show you a few different ways to calculate that with a few tools that we have. But the savings amount, so you have all your different sources of income, you might need a certain amount of money, and your guaranteed income sources that you've kind of factored in only come up to here. You've got a gap, and you've got to make up that gap with your own savings. This is where people will save with their RSPs and TFSAs, typically above and beyond that through a non-registered account as well. But this is your responsibility to make up that gap between your anticipated spending need and your anticipated income. Boom, that's your problem now. Okay, so let's piece this together a bit. Let's put some hypothetical numbers together. So if you need to spend about $7,000 a month at 65, that's in the ballpark of what I often see. You might be more, you might be less. I don't know. We're just going to use a number here. And so that's going to be about $9,300 pre-tax. So if you're spending $7,000, that means we have to factor in a tax amount above and beyond that. So that's $9,300 pre-tax. That's pretty high. I'm overestimating there if you're eligible for income splitting. So if you have a spouse, your average tax rate is probably not going to be that 25%. But if you're a single person and you're spending that much, it's a little bit low because you don't have the advantage of being able to income split. So whatever, we're going to use an average amount of 25% here just to factor that in. It's not advice. This is just a general idea. And so if we're using ballparks here, say 900 might come from CPP, 700 might come from OAS, so that's 1,600 altogether, and plus your spouse's income from those two sources, maybe that's the same. So now you have about $3,200 pre-tax from government benefits. So if you need $9,300 pre-tax and you're getting $3,200 pre-tax, you need to come up with $6,100 per month or $73,000-ish annually plus inflation, right? So those other sources, so CPP and OAS, they have an inflation factor baked in, and those estimates will increase along with that inflation factor along the way. But your savings amount doesn't automatically increase with inflation. Your income doesn't necessarily automatically increase with inflation, but your spending needs to, because that is the definition of inflation, right? That is the cost of living, the cost of goods and services to be able to exist. That is going up. That is inflation. And in a typical world, that's in the ballpark of 2 to 2.5%. The last decade was quite a bit lower than that. In the very most recent years, it's quite a bit higher than that, but it's coming back down to a more realistic range that we can anticipate for a longer period of time. So if we are someone who's anticipating retirement at 65, coming up with a savings gap of $73,000 of income plus inflation per year, pre-tax, how do you actually figure out how to get from here to there? Well, next week, we are going to figure out a few different ways of how you can calculate that. There's some that are more complicated, some that are a little bit simpler, but we're going to talk about some options for how to get there, and I will show you some of the tools that we use to be able to do that. So this was just a quick look at step 4 on your retirement roadmap journey, is just figuring out where your income is going to come from and trying to find that gap between what you know is going to come in and what you need to come up with on your own. If you have a good idea of how much you need to come up with on your own in terms of a monthly or an annual amount, now we can do a little bit of a math exercise to figure out a few details from there to set you up with a plan to get from here to there. So that's going to be next week's episode. Thank you for watching. If this was interesting for you, text this episode to a friend. Text it to a parent or an aunt and uncle or someone that you're close to that's in this range of planning for retirement. And hopefully it'll be helpful for them too. Thanks for tuning in to this week's episode, and I will see you next week.